China is a social market economy led by a communist political party. Its policy framework and the implementation of its policies therefore may differ from the West. We must also remember that China is an emerging market and as such can be volatile. There is actually a fair amount of overlap between China and the West in terms of areas of concern, including the monopolistic behavior of some of its companies, particularly in the tech sector. Against this backdrop, understanding the country's policies and the rationale behind those is critical, as is the case for understanding the phases of its transformation. China is continuing its growth path, and its strategy requires a vibrant private sector, which currently represents 60% of GDP. Innovation is a vital part of its plan and a continuing investment opportunity. Therefore, we continue to view China as an important asset class, and our message is, don't be put off by setbacks, but do be rational about the overall policy and strategy context in China, but navigate carefully. China has spent 2 decades emerging onto the world stage. Now it's positioning and repositioning itself geopolitically for phase 3 by elbowing its way into the top ranks globally and moving forward with its new phase of domestic development. As a communist-led market economy, China aims to balance social inequality as well as to continue to increase its value added in many sectors on a global basis. This commitment to common prosperity and the reduction of some of its vulnerabilities exposed by the US sanctions, for example, with the recent trade wars, is behind many of the recent actions. This includes changes in regulations in the tech and education sectors to avoid monopolistic behavior, as well as putting more emphasis on the development of national champions in areas such as hard tech or industrial and medicine tech, for example. Note that China uses 30% of semiconductors worldwide, but currently only produces 10%, therefore very large vulnerability. The world slowly adjusts to integrate China in phase 3 of its development. After phase 1 WTO access of China to the World Trade Organization, phase 2 being when China overtook Japan as the second largest economy after the great financial crisis. And so in phase 3, we should expect some tensions from time to time between China and particularly the US as China elbows itself from a geopolitical standpoint to the world stage, as well as continue to affirm its place as the second largest economy in the world. But China could also work very closely with other nations on vital issues such as climate change. It is, after all, the largest carbon emitter and as such is an integral part of any future solutions over the next decades for the planet. China is the second largest economy in the world and a key geopolitical player. Its bond markets and stock markets are now some of the largest in the world and should not be ignored. Investing in Chinese equities requires both strong bottom-up stock-picking skills and an awareness of ESG principles, especially on the risk side, but also a very keen understanding of macro factors as well as the policy framework and its potential changes that China operates in. Approaching Chinese equities with a blend of high-quality, sustainable, conviction portfolio in A shares and H shares, but also thematic opportunities is best. We believe that active management is essential for navigating this environment and for using volatility to build positions that align with China's strategic direction.